Hey Bowtie Nation, Joseph Hogue here with 10 stocks too cheap to ignore any longer. Stocks trading for an average 54% discount to their own long-term valuations and primed for double-digit returns. I'll walk you through how to find these, highlight those 10 ridiculously cheap stocks, but I have to warn you, we're not just buying stocks that have fallen in price. It's one of the biggest mistakes investors make, chasing that stock lower, trying to catch the proverbial falling knife and getting their portfolio cut to shreds. So I'm also going to show you how to know when a cheap stock has stopped falling and is ready to move higher. First up, if you've played the lottery or scratch tickets, and you know you have, you've probably used International Game Technology, ticker IGT. Shares here are down 27% in the last year and trade just under 1 times on a price-to-sales basis. That is a 37% discount to the price multiple it traded for just mid-last year. IGT is a leader in lottery and gaming services, following lottery industry sales up 7% a year. Just over half of the 59% of revenue is from lottery sales, with 36% from gambling and 5% from a growing digital platform. That iGaming digital growth is a big catalyst here, and cost-cutting has helped the company become more profitable, both of which should help boost the valuation back to that higher multiple. The company is a cash flow machine also here, generating over $1 billion in operational cash flow and $619 million in free cash flow just last year, a record for IGT. That slide in the stock price looks like it might have slowed in the last month here, with shares down just 3%, which has brought the RSI up a little bit. I'll explain what I'm looking for here and what it means in a minute, but look at the analyst forecasts, with even the low target at 26% higher and the high target for 46% potential return. I'll show you how I found these next, but I also want to highlight AMN Healthcare, ticker AMN, down 34% over the last year. The company is a leader in healthcare staffing with over 200,000 placements just last year. Folks, I've worked as a labor economist, and I can tell you the U.S. is already in a long-term shortage for nurses and healthcare workers, and with the aging population, it's only going to get worse. The company estimates we'll be short 124,000 doctors by 2034, and hospitals typically see 30% annual turnover in staffing, making staffing firms like AMN a bare necessity. Their shares now trade for just 0.59 times on a price-to-sales basis, a 40% discount to their valuation over the last year. The stock has continued to fall though, down 8% this last month, but is very close to that support we see it. And this is another one with unanimous consensus among analysts covering the stock. Even the low price target here is for 22% higher, while the average would be a 33% return to $76 a share. We've still got 8 more cheap stocks to buy, but all you out there in the nation know I'm not just about dropping a list of stocks in your lap and saying, here, go buy these. I want to give you the tools to be a better investor, to know how to pick your own stocks. So I want to walk you through how I found these and what to look for. And first, looking for cheap stocks, you have to settle on a measure for cheap. Here, I'm going to be using the price to sales or price to revenue valuation. That's the total value of the shares, the market cap, divided by the company's sales over the last year, how much investors are willing to pay for those every dollar of revenue. And now you've probably heard the price to earnings multiple used way more often, how much investors are paying for every dollar in earnings or profits per share. There are a couple of reasons why I like using the price to sales ratio more. First is you won't always have that PE ratio to use. If a company has negative earnings this year or in the past, then because you can't divide by a negative number, that price to earnings ratio is just going to show up as NA in most investing platforms. Using the price to sales or price to revenue ratio though, almost all companies have some revenue, so you're always going to be able to find this number. Also though, and I don't want to get all accounting nerd on you, but there are 101 tricks management can use to manipulate a company's profits, make it look higher than they actually are. In fact, one of the first things you learn as a professional analyst is how to back out all the accounting shenanigans in a financial statement. That's not to say that the sales or revenue of company books are pure like a Catholic after confession, but it is a lot harder to fudge those reported revenue numbers than profits, so using that price to sales valuation is just a truer measure. Once you find that price to sales valuation, and it's easy to find on any investing platform, here on Yahoo Finance it's in the statistics tab here, then you compare that against 2 other numbers to find those truly cheap stocks. First, you're going to compare that current valuation against the stock's own history. Is the stock cheaper now compared to the valuation investors have been willing to pay in the past? Then you also want to compare it against the other stocks in the company's industry. Is the valuation lower than what investors are paying for its competitors right now? Now, finding a cheap stock isn't enough though. Just ask anyone in shares of AMC over the last 4 years. A cheap stock can always get cheaper. Finding the cheap stocks to buy right now, the ones ready for a rebound, means using technical analysis to find those inflection points in a stock's price. For this video, I looked at 2 signals here, a near-term price momentum and the relative strength index, or RSI. Now, to find stocks ready to rebound, I just compared the 1-year return with what the stock has done over the past month. Newton's first law of motion is surprisingly relevant to stocks, in that a falling stock just tends to keep falling, while a rising stock price continues to rally until some catalyst acts against it and sending it into the other direction. Now, it's not some physical law of markets, but just that investor sentiment tends to drive a stock in one direction until that sentiment turns. So by filtering for those stocks that have turned positive near term, or have at least slowed their price swings lower, gives you a sense of those where investors' sentiment may be turning more positive. I'm also using the Relative Strength Index, or RSI, a momentum signal in stocks from 0 to 100 that shows when a stock is overbought or oversold. It's a near-term indicator showing the price momentum, but here, instead of showing the stocks where sentiment is already turning, it can show us where stocks have gotten too cheap or really too expensive already. Technically, anything over 70 is overbought or too expensive, and under 30 is oversold, but you have to balance this with the other near-term indicator that we're using. That's because a stock that has already started to turn higher, that key signal we're watching, make sure we're not trying to catch a falling knife, is going to have a little higher RSI because that momentum has already started. So instead of only buying stocks in the 20s or 30s on the RSI, I'm willing to go a little higher up for those deep discount stocks that are already on the way back up. Of course, I'm also doing that fundamental analysis that we always look at here on the channel, not only finding those cheap stocks, but the ones with good fundamentals and a competitive advantage among their peers. Next on our list, a stock that has already started running, but with room to grow, Newmont Corporation, ticker NEM. Newmont is the world's largest gold producer, with mining on 4 continents and a strong producer in copper and other minerals as well. The company reports over 128 million ounces of reserves in gold alone, and all-in sustaining costs of extraction of just $1,200 an ounce. With the price of gold surging to a new all-time high recently, Newmont is collecting almost twice what it costs to dig it out of the ground. That alone has pushed shares up 10% in the past month, boosting the dividend and supporting a $1 billion share repurchase program, and the stock is still undervalued compared to its long-term history. Because of that recent jump, the RSI is higher, but analysts believe the stock can go higher still, as much as 43% higher to a top price target among 13 analysts. This next one is more of a short-term value play here with Warner Brothers Discovery, ticker WBD, with shares down more than 38% over the last year, but turning positive in the last month. The stock is trading for a 43% discount on its price-to-revenue basis. And I say short-term because I think Netflix continues to dominate that streaming theme with its advantage in international production, but there is a near-term rebound potential in Warner Brothers. Revenue in the fourth quarter took an 18% hit on the actors and writers strike from last year, with the first quarter expected down another 4%, but I feel like we're kind of in a low point of entertainment impacted by last year's strikes. Have you noticed that how movies suck lately? It's all low-budget, independent movies that should have been direct to DVD. Seriously, the wife and I went to go see Civil War last week, and by comparison, Captain America Civil War was a great movie. So as the better movies come back, we should see revenue increase after this quarter, seeing that valuation multiple improve and could be closer to analyst estimates for a 50% upside on average, and as high as 135% higher to $20 a share. We'll get back to those cheap stocks to buy next, but a big part of this strategy is something we don't talk about much on the channel, that technical analysis. I'm showing you the RSI and price inflection points here, but to really know when to buy or sell a stock, you need to go deeper into those stock signals. That's why I'm relaunching my stock signals and technical analysis course with a 30% discount. Save $150 off with the coupon code in the video description below. The complete course includes more than 30 videos on how professional investors trade stocks and the stock signals they use to know exactly when to buy. You'll also get the bonus material on fundamental analysis, trade examples, and the trading worksheets to follow your trades. Click through the link I'll leave in the description and check out the free preview or try it risk-free for 14 days. You'll learn how to find stock trades and never run out of ideas, how to identify price changes before they happen, and even when to buy or sell your long-term investments. That special relaunch discount is only available with the link in the video description below, so check that out. Back to our stock list though, with Walgreens Boots Alliance, ticker WBA, trading for half of its long-term valuation. Now, the entire pharmacy and healthcare market has struggled since the pandemic. Shares of competitor CVS are also down 36% from its peak, and while I do like CVS better for a longer-term investment, Walgreens has the near-term catalyst to send it higher. Shares are down 49% over the last year and trade for just 0.11 times its sales, half the 0.23 times revenue the stock was trading at less than a year ago. While it hasn't started rebounding yet, down 13% in the last month, we could get very good news soon. Recently, the company offloaded its pension debt tied to the Boots pharmacy chain in the UK, a move that will allow it to sell the segment. Walgreens has also started selling off investments in other businesses, like its Chilean drugstore chain and shares of Cencora, formerly drug wholesaler AmerisourceBergen. Nation, these are all classic moves to downsize the company into its core cash-flowing business. Nearly $7 billion in proceeds from the Boots sale, along with other sources, are going to help it pay down that long-term debt of $30 billion. And while the company shocked Wall Street this year by cutting its dividend for the first time in 47 years, it's still all part of the plan. This is a company cutting its costs, selling non-core assets, and setting itself up for a sale of the entire company or to take itself private in a leveraged buyout. Walgreens had already been a target of private equity firm KKR for a buyout in 2019 at $70 billion, almost 4 times its current value. Now they could get it for just $25 billion. Here, even the low target is for a 10% pop in the shares, with a high target among 13 analysts for a 104% return, likely watching for that big turnaround news. Genpact Limited, ticker G, is a $5.6 billion consulting services firm, with shares down 29% over the last year as investors worry that spending cuts by businesses are going to hit those consulting and staffing firms. It looks like the pain has slowed, though, with the shares down just 1% in the last month and still trading for a 35% discount to that price-to-sales basis. Genpact works in the technology-driven side of consulting, recently focusing on helping companies adapt to that AI revolution, which should help keep revenue growing on the demand for that trend. Revenue is expected up just 3% this year, but 6% next year, which should help it turn around that recent slide. And this is another one with even the lowest analyst target a positive return. The average of 9 surveyed analysts is for 20% upside, while the high would be 36% higher. Medical Properties Trust, ticker MPW, has been one of the most disappointing stocks in my portfolio, but looks like it might finally turn higher. The world's second largest hospital real estate owner has 442 properties and rare international exposure for a REIT, operating in 34 U.S. states and 9 countries. Shares are down 48% over the last year and much more before that, but have rebounded 10% in the last month on news that the company is paying off its debt with strategic asset sales. For example, the stock jumped 18% when the company announced it had closed on a majority interest sale of its Utah hospitals for $1.1 billion, and there are fundamental catalysts for this one as well. With health insurance stocks falling on higher medical costs and increased procedures, we could see improved hospital profitability flow down to that better cash flow for medical real estate owners like MPW. Funds from operation, or FFO, are expected lower by just 2% this year. That is a big improvement over the drop last year, and to $1.25 per share, which puts the valuation at just 3.3 times on a price to FFO basis. That is a 63% discount to the 9 times price to funds from operations average, and even a revaluation to maybe 6 or 7 times FFO would take this stock back to $10 each. Now, a lot of analysts have given up on MPW, with the average target only at $4.80 a share, but with 31% return to that high target, I think this one surprises the market over the next year, paying down its debt and going much higher. Next, I'm going to highlight a stock with an 84% discount to its recent valuation, but I want to get your input on this as well. What do you look for in cheap stocks, and what are the signals you use to know when it's time to buy? So scroll down there and let us know in the comments, how do you find those value stocks to buy? WW International, the old Weight Watchers, seems to have found support recently and has the highest potential upside among the 10 stocks. Shares have plunged 79% over the last year as investors worry that weight loss drugs are going to destroy the dieting industry, but Weight Watchers has 2 things going for it. First, I think it's an overreaction. Not everyone wants to be hooked on a needle medication every week for the rest of their lives, especially when that can cost them hundreds of dollars a month after insurance. But also because WW has launched a clinic service that can prescribe those weight loss drugs as part of the program, and early estimates are for subscriptions that are way over forecast. Now, the market could get a surprise when the company reports next week, with shares trading for just 0.14 times sales. That is a fraction of the valuation multiple over the last year. While revenue and earnings aren't expected to turn yet, the company has until 2028 before debt maturities are due, which gives it plenty of time for change. And analysts see the potential here, with an average target that is 228% higher, and a high that is almost 6% from here. Alibaba Group Holdings, ticker BABA, isn't down as much as the others on the list, only down 15% over the last year, but this is still one with a deep discount. The largest e-commerce company in China trades for about 1.4 times its sales, a discount of 36% on the 2.2 times valuation at the end of last year, and less than half the price multiple investors are paying for Amazon. Now, you out there in the nation know I'm not usually a fan of these Chinese stocks, and they always trade at a discount to their American peers, but Alibaba has a lot of levers it can pull to boost that valuation, and it could happen soon. The company has already discussed spin-off of assets into IPOs to unlock some of this value, including the cloud and logistics units. It's the dominant leader in both cloud, payments, and e-commerce in China, and is expanding internationally. Now, much of those plans have been postponed as the company stages that turnaround, but this one is deep in value territory. In fact, Michael Burry has increased his stake in BABA to its largest in his portfolio at over 6% of assets. And Alibaba is another one where even the low analyst target is above the current price, and the high target would be an 86% return from here. We've still got one more stock to watch, one with a 90% upside potential on its valuation, but the only thing better than these returns is getting that cash in your pocket. Check out this video next, and I'm going to show you how to invest $1,000 for dividend income every single week. We might have to wait longer, but the upside is the highest here in ChargePoint Holdings, ticker CHPT, trading for 90% discount to its valuation history. ChargePoint is the market share leader in EV charging, the major bottleneck in adoption for electric vehicles right now, and while sales of EV cars and trucks have slowed lately, volume still grew by 25% over the last year to over 1 million cars sold. Not only is ChargePoint revenue directly proportional to that still growing penetration of EV cars, there is a hidden catalyst here that is taking revenue even higher, and that is subscription revenue, which grew by 40% annual pace last quarter to $120 million, nearly a quarter of its total revenue. That subscription and support revenue is going to continue to grow because customers are extremely sticky here for the company. Once they buy that charging equipment, that subscription revenue is locked in. And yes, while investor sentiment for EV stocks has plunged and the adoption of new vehicles has slowed, we're just starting to see the $7 billion in charging station stimulus dollars spent to build up that infrastructure. Here, ChargePoint is trading for just over 1x on a price-to-sales basis, and while I don't expect it to get back to that growth stock valuation it saw last year, even a pop to 2x revenue would be a 100% return. The low analyst target here is for 10% higher, and the high target is for 340% return, making the potential worth the risk. Get your special relaunch discount on that stock signals course and learn how to use technical analysis to know exactly when to buy or sell a stock with the coupon code in the description below. Or click on the video to the right for a $1,000 dividend portfolio that pays you every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.